Welcome to our exploration of the demand for labor and capital in economics. These two fundamental resources drive production and shape the structure of any economy. Understanding how businesses and industries decide how much labor and capital to employ is crucial for grasping broader economic trends. In this video, we'll break down the concepts, examine the factors influencing demand, and see how these forces interact in real-world markets. Let's begin by defining what economists mean by demand in the context of labor and capital, setting the stage for a deeper dive into each component. Labor demand refers to the number of workers that firms are willing and able to hire at different wage levels. It's not just about the total number of jobs, but about how businesses respond to changing economic conditions. When wages rise, firms may hire fewer workers while lower wages can encourage more hiring. This relationship forms the basis of the labor demand curve, which typically slopes downward. The demand for labor is derived from the demand for the goods and services that labor helps produce, making it a key concept in understanding employment trends. Capital demand, on the other hand, involves the desire and ability of firms to acquire physical assets like machinery, buildings, and technology. Just like labor, the demand for capital depends on its cost, often measured by interest rates or rental prices. When the cost of capital is low, firms are more likely to invest in new equipment or expand their facilities. Conversely, higher costs can dampen investment. The demand for capital is also derived from the demand for the final products that capital helps to produce. Both labor and capital are examples of derived demand. This means their demand is not for their own sake, but because they are needed to produce goods and services that consumers want. For instance, a bakery hires more workers and buys more ovens only if there's an increase in demand for bread. This connection links the labor and capital markets directly to consumer preferences, making them responsive to shifts in the broader economy. Productivity plays a vital role in determining the demand for both labor and capital. When workers become more productive, perhaps through better training or improved technology, firms can produce more output with the same amount of labor. This can increase the value of labor and encourage firms to hire more workers or invest in additional capital. Conversely, if productivity falls, the demand for these inputs may decline, affecting employment and investment decisions. Key concept in labor demand is the marginal product of labor, the additional output produced by hiring one more worker. Firms compare the value of this extra output to the cost of hiring the worker. If the value exceeds the wage, hiring makes sense. As more workers are added, however, the marginal product typically decreases, a phenomenon known as diminishing returns. This principle helps explain why firms don't hire unlimited workers, even if wages are low. Similarly, the marginal product of capital refers to the additional output generated by investing in one more unit of capital, such as a new machine. Firms weigh the benefit of this extra output against the cost of acquiring the capital. As with labor, the marginal product of capital usually declines as more capital is added, due to diminishing returns. This helps firms determine the optimal level of investment in capital assets. Wages are a critical factor in labor demand. When wages rise, the cost of hiring workers increases, which can lead firms to reduce the number of employees. Conversely, lower wages make hiring more attractive. However, other factors such as productivity, technology, and market conditions also influence labor demand. It's a dynamic process, with firms constantly adjusting their workforce in response to changing economic signals. Interest rates play a similar role in capital demand. When borrowing costs are low, firms are more likely to invest in new equipment or expand operations. High interest rates, on the other hand, can discourage investment by making capital more expensive. This relationship is central to understanding how monetary policy and financial markets influence business decisions and economic growth. Firms often face choices between using more labor or more capital. For example, a factory might hire additional workers or invest in automation. The decision depends on the relative costs and productivity of each input. If labor becomes more expensive, firms may substitute capital for labor and vice versa. This flexibility allows businesses to adapt to changing market conditions and technological advances. Technological advancements can dramatically alter the demand for both labor and capital. Automation, for instance, may reduce the need for certain types of labor while increasing the demand for high-tech capital. At the same time, new technologies can create entirely new industries and job opportunities. The interplay between technology, labor, and capital is a driving force behind economic evolution. Elasticity measures how sensitive the demand for labor or capital is to changes in wages or interest rates. If demand is elastic, small changes in price lead to large changes in quantity demanded. Inelastic demand means that price changes have little effect. Understanding elasticity helps firms and policymakers predict how markets will respond to economic shifts and policy changes. Demand for labor and capital can differ in the short run versus the long run. In the short run, firms may have limited ability to adjust their use of capital, focusing more on changing labor levels. Over the long run, however, firms can invest in new capital, change production methods, or even enter new markets. This distinction is important for understanding how businesses respond to economic shocks and opportunities. Different industries have varying demands for labor and capital. For example, manufacturing often requires significant capital investment in machinery, while service industries may rely more heavily on labor. These differences shape the structure of the economy and influence employment patterns. Understanding industry-specific demand helps explain why some sectors are more sensitive to wage or interest rate changes than others. Government policies can significantly affect the demand for labor and capital. Minimum wage laws, tax incentives for investment, and regulations all play a role. For instance, a higher minimum wage may reduce labor demand, while tax breaks for equipment purchases can boost capital demand. Policymakers must balance these effects to promote economic growth and stability. Globalization has transformed the demand for labor and capital worldwide. Firms can now source labor and capital from different countries, seeking the most cost-effective options. This has led to shifts in employment patterns, investment flows, and even the types of skills in demand. Understanding globalization's impact is essential for navigating today's interconnected economy. Recent trends in the labor market include the rise of gig work, remote employment, and increased automation. These changes affect how firms demand labor, with some jobs becoming obsolete and others emerging. Staying informed about labor market trends helps workers and businesses adapt to the evolving economic landscape. Capital markets are also evolving, with new financing options, technological innovations, and global investment opportunities. Firms now have access to crowdfunding, venture capital, and other sources of capital beyond traditional banks. These trends influence how and where businesses invest, shaping the demand for capital in the modern economy. Human capital refers to the skills, knowledge, and experience possessed by workers. Investing in education and training can boost labor productivity and increase the demand for skilled workers. Firms that value human capital are often more competitive and innovative, highlighting the importance of continuous learning in today's economy. It's important to distinguish between physical capital, like machines and buildings, and human capital, which encompasses worker skills and abilities. Both are essential for production, but they play different roles. Firms must balance investments in physical and human capital to maximize efficiency and growth. Labor and capital often complement each other in production. For example, skilled workers may be more productive when using advanced machinery. This complementarity means that investments in one input can increase the demand for the other, creating a positive feedback loop that drives economic growth. In some cases, labor and capital can substitute for each other. For instance, a company might replace workers with automated systems if it becomes cost-effective. The degree of substitutability depends on the nature of the production process and the available technology. Firms must carefully assess when substitution makes sense. Labor unions can influence the demand for labor by negotiating higher wages, better working conditions, and job security. While unions can improve worker welfare, higher labor costs may lead firms to hire fewer workers or invest more in capital. The impact of unions varies across industries and countries. Capital mobility refers to the ease with which firms can move capital across borders or between projects. High capital mobility allows businesses to seek the best investment opportunities, but it can also lead to volatility in local economies. Understanding capital mobility is essential for analyzing global investment patterns. Labor mobility describes the ability of workers to move between jobs, industries, or geographic regions. High labor mobility can help economies adjust to changes, reduce unemployment, and match workers with available opportunities. Barriers to mobility, such as regulations or skill mismatches, can limit these benefits. Modern economies often experience skill-biased demand, where firms increasingly seek workers with advanced skills and education. This trend is driven by technological change and globalization, leading to higher wages for skilled workers and greater inequality. Addressing skill gaps is a major challenge for policymakers and educators. Capital deepening occurs when firms increase the amount of capital per worker, such as by providing more advanced tools or equipment. This can boost productivity and wages but may also reduce the number of workers needed. Capital deepening is a key driver of economic growth in developed economies. Industries can be classified as labor-intensive or capital-intensive based on their primary input. Labor-intensive industries like hospitality rely heavily on workers, while capital-intensive sectors such as manufacturing depend more on machinery and equipment. This classification affects how industries respond to changes in wages or capital costs. Demographic changes, such as aging populations or migration, can influence the demand for labor and capital. An older workforce may increase demand for healthcare services, while migration can provide new sources of labor. Demographics shape the long-term outlook for both labor and capital markets. Investing in education and training is essential for meeting the changing demand for labor. As technology evolves, workers need new skills to stay competitive. Lifelong learning and workforce development programs help ensure that labor supply matches the needs of modern employers. Firms that invest in innovation often experience higher demand for both labor and capital. New products, processes, or business models can create jobs and require new equipment. Innovation is a key driver of economic growth and competitiveness in the global marketplace. Firms with significant market power can influence the demand for labor and capital in their industries. Large companies may set wage standards or drive investment trends, affecting smaller competitors. Market power shapes the competitive landscape and the allocation of resources. Economic fluctuations, known as business cycles, impact the demand for labor and capital. During booms, firms hire more workers and invest in capital. In recessions, demand for both inputs falls. Understanding business cycles helps explain the ups and downs of employment and investment. Entrepreneurs play a crucial role in shaping the demand for labor and capital. By starting new businesses and introducing innovations, they create jobs and require investment in capital. Entrepreneurship drives economic dynamism and helps economies adapt to change. Regulations can influence the demand for labor and capital by setting standards for safety, environmental protection, or working conditions. While regulations can increase costs, they may also create new opportunities for investment and employment in compliance-related industries. Environmental concerns are increasingly shaping the demand for labor and capital. Firms may invest in green technologies or hire workers with expertise in sustainability. These trends reflect growing consumer and regulatory pressure to address environmental challenges. Digital transformation is reshaping the demand for both labor and capital. Firms are investing in digital tools, automation, and data analytics, which require new types of capital and skilled workers. This shift is creating opportunities and challenges across industries. Outsourcing and offshoring allow firms to access labor and capital in other regions or countries. These strategies can reduce costs but may also impact domestic employment and investment. The global distribution of labor and capital is a defining feature of modern economies. Infrastructure such as transportation, communication, and energy systems supports the demand for labor and capital. Well-developed infrastructure attracts investment and enables efficient production, while poor infrastructure can limit growth. Governments often invest in infrastructure to stimulate economic activity. Financial markets facilitate the flow of capital by connecting investors with firms seeking funding. Access to finance is crucial for businesses to invest in capital and expand operations. Well-functioning financial markets support economic growth and job creation. Ultimately, consumer preferences drive the demand for goods and services, which in turn shapes the demand for labor and capital. Firms must stay attuned to changing tastes and trends to remain competitive and allocate resources effectively. Let's look at manufacturing as a case study. This industry typically requires significant capital investment in machinery and equipment, but also relies on skilled labor. Changes in technology, wages, or capital costs can have a major impact on production decisions and employment levels. In contrast, the service sector is often more labor-intensive, relying on human interaction and expertise. While technology is increasingly important, the demand for labor remains high in areas like healthcare, education, and hospitality. Understanding these differences helps explain employment trends across sectors. Looking ahead, the demand for labor and capital will continue to evolve as technology advances, demographics shift, and global markets change. Staying adaptable and investing in skills and innovation will be key for both workers and firms. The interplay between labor and capital remains at the heart of economic progress. In summary, the demand for labor and capital is shaped by a complex web of factors, including wages, interest rates, technology, government policy, and consumer preferences. By understanding these dynamics, we gain insight into how economies function and how businesses make critical decisions. Thank you for joining us on this journey through the fundamentals of labor and capital demand in economics.